Economic data points are due out this week, from CPI tomorrow to jobless claims on Thursday. And of course, the Fed's decision comes right in the middle of all that. Already this morning, a key gauge of inflation expectations that could factor into the Fed's next move. We turn, of course, to senior economics reporter Steve Leisman for more. Hi, Steve.
Hey, Kelly, yeah, by Thursday, investors are going to have a lot of new information on inflation, the consumer, the Fed, and the job market. Tons, as you say. It's going to set expectations for the months ahead. Here's what Wall Street forecasters think will happen. They're not always right, but here's the consensus. Inflation CPI headline falling to 4%. That's a big drop from the 4.9 we had last month. But you see that? That's the core, ex food and energy. That's the sticky part, just down 2 ticks and still at a high level of 5.3% to maintain the Fed's concern. The Fed expected to skip and maybe hint of a hike, talking about a hawkish pause or a hawkish skip there. And the PPI comes that day as well. Thursday, we're going to watch jobless claims a little more closely than usual because we had that pop last week at 261, expected to come down, be a little bit more tame this week. There was talk about it being a seasonal adjustment issue. And I like retail sales as a big number this week. It seemed down a tick, a tenth of a percentage point from the 0.4% rise in the prior month. But take out autos, and it looks a little bit better if you take out autos. Markets have embraced the skip and hike sequence, if that's what you want to call it, with a 73% probability of a pause this meeting and a 69% probability that they'll hike in July. The good news, at least for now, July is the last rate hike that's priced in. The bad news, no longer any cuts priced in for this year in the futures market. New Fed forecast this week could move the goalpost even further out. The Fed reported mixed news in its efforts to control inflation expectations. The New York Fed says longer-term inflation expectations did rise. Here are the numbers. The 1 year fell by 0.3. That's a good number, especially because it wasn't because people thought gas prices were coming down. It was other things that were responsible for it. The 3 year at 3, up a tick. 5 year at 2.7, up a tick. Those are areas of concern. The Fed hopes to keep high inflation expectations from becoming entrenched in the minds of businesses and consumers. It's slowly achieving that goal short term, but the longer term numbers seem anchored maybe a bit on the high side right now, Kelly.
I can't remember what they used to look like back in the 1.5% inflation days, because I think they were always a little high. But what I was going to say, though, is the 1 year drop seems pretty noteworthy. I mean, the 1 year hike in the past has been where the Fed started to get super concerned. So that coming down the way that it has, again, maybe a lot of that's gas prices. But regardless, that seems like a pretty dovish development.
It is. And one way to think about it is, what number do you use, Kelly, and everybody has their own, to figure out what the real funds rate is? What are you deflating it by? Current inflation? If you use current inflation, let's say use that high 4%, the Fed is a percentage point. But some people like Jeff Lacker, a former Richmond Fed president, likes to use the inflation expectations number 1 year ahead because he says that's the choice you're making.
Right.
Am I going to save now or am I going to spend now? And so when that number comes down, that 1 year ahead inflation expectations comes down, the Fed gets relatively tighter or looks relatively tighter or has policy relatively better in the right place.